If a company makes $1 billion, so they pay their employees, they pay their rent, they pay all their other expenses, and then at the end of the year, they have $1 billion in their bank account, how much should their stock be trading for? $10 a share? $100 a share? $1,000 a share? Well, in this video, you're gonna learn what moves the stock market. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com and welcome to The Minority Mindset. Let me give you a little bit more information. So let's say a company makes $1 billion in profit, and to keep things simple, let's say that there are 1 billion shares outstanding. So if the stock price trades for $1 a share, that means this company is valued at $1 billion. And if the stock price is trading at $10 a share, that means this company is valued at $10 billion. So what's the right stock price? $1 a share or $1,000 a share? Well, it depends. If this company was a tech stock based off of 2020 numbers, this stock might be trading for something like $100 a share, which would value this company at $100 billion based off of their $1 billion of profit. If it was a healthcare company, it might be trading for something like $60 a share, which would value the company at $60 billion based off of their $1 billion of profit. And if this company was a restaurant, it might be trading for something like $25 a share, which would value this company at $25 billion based off of their $1 billion of profit. I say might for all of these things because a company's stock price depends on a handful of factors. You have the strength of the economy as a whole, you have the number of investors out there, and obviously you have the strength of the company. Now, before we get too deep into this, make sure you hit that thumbs up button below, because if you don't, well, the way the YouTube algorithm works, then YouTube will be less likely to show you any of our other financial news and education videos. When you buy stock, you're buying shares or ownership in a company. So if you go out and you buy shares in McDonald's or Chipotle or Amazon or Tesla, you've become one of the owners of these companies, and when they make money, their company will become more valuable and the stock price will go up and you will get richer. Except it's a little tricky because stocks don't always move linearly or logically, especially in the short term. If you invest in McDonald's and McDonald's sells 10% more burgers, you might expect that their stock price should go up by 10%. But that's not how it works. I mean, depending on what people expect, their stock price might go up by 20%, or maybe their stock price will fall by 5%, or maybe their stock won't do anything. Warren Buffett says it the best. In the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. You have a lot of emotion which moves stock prices, which can make the stock market look illogical and crazy, especially in the short term. Like if McDonald's came out and they said that they're launching a new fries with guacamole, people might get really excited and investors would start buying up the stock and the stock might start soaring. Well, over the long term, if the price goes too high, it will eventually correct and come back down. And over the long term, strong companies come out on top and emotional companies end up on the bottom. At the end of the day, the price of a stock depends on just one thing: how many buyers and sellers there are for that stock, because the price of anything depends on what someone else is willing to pay for it. Back in the 1600s in the Netherlands, people thought that tulips, the flower, was the secret to building wealth and getting rich. So people would literally sell their homes and then take all the cash from their home sale and go out and buy one tulip bulb because they thought that's what was gonna make them rich. And eventually this bubble burst, but it goes to show you that the price of something depends on what someone else is willing to pay for it. This is a true story and it was called tulip mania. When you have more buyers than sellers, the price of a stock will go up. And when you have more sellers than buyers, the price of a stock will come down. So if you want to really understand what moves the stock market, you need to understand what changes how many buyers and sellers there are. The quick answer to that is anything. I mean, even in this digital age, a tweet from a celebrity can impact the stock price. The long-term answer, which I kind of hinted at in the beginning of this video, are the economy, the number of investors out there, and the strength of the company. When we are in a bad economy, like a recession, people tend to be more conservative with their money. Nobody wants to spend money because they're scared of losing their job and losing an income stream, so they just keep their cash to themselves. And this is not good news for companies, because that means your company, your investment, is not making as much revenue. And people lose faith in the economy during a recession. We've seen this happen time and time again through almost every recession in the past. So when you're in a recession, you have less people wanting to invest their money in the stock market. And if you remember what I said just a minute ago, the price of a stock depends on how many buyers and and sellers there are. So if you have less buyers out there, that would have downward pressure on the stock market and your investment. This brings me to the second point. Understanding the number of investors out there. Back before the 1980s, investing in the stock market was reserved for the wealthy or the very sophisticated. If you wanted to buy a stock then, you couldn't just go on your phone and make a trade. You had to have a relationship with a stockbroker or a financial planner. But it didn't end there, because if you actually wanted to make a trade, you'd have to listen to sales pitches for different stocks, and you'd be reading pages and pages of stock prospectuses. Stock market investing was not accessible for the majority of Americans, which is why most investors were either big institutions or wealthy people. Things changed in 1980 when the government worked with Wall Street to create the famous retirement plan known as the 401k. Now all of a sudden you had a whole new wave of buyers in the stock market, because millions and millions of Americans created these new retirement accounts called the 401k, which meant that their money was managed by a money manager on Wall Street, and this money manager managed so many Americans' retirement accounts by taking this retirement money and putting it in stocks on Wall Street. The 1980s was known as the roaring 80s in the stock market, because there was this huge wave of buyers, because you had regular Americans now having access to the stock market through their retirement accounts. Now the stock market is open to institutional buyers, wealthy people, and regular people through their retirement accounts until the 2000s and the 2010s. This started in the 90s, but it really took off in the 2000s because you had online brokerages like Charles Schwab and TD Ameritrade paving the way for retail traders and investors to be able to make investments and stock trades off of their phones or computers. Now anybody could be a stock market investor as long as you had a computer and access to some cash, and you were okay paying the commission fees. And then in the 2010s came the growth of commission-free brokerages like our sponsor Webull, so now anybody with $100 can buy and sell stocks or ETFs right off of their phone or computer. With Webull, all you have to do is create a free account, fund it, and then you can buy or sell whatever stock or ETF you want without paying a penny in commission, because Webull is a commission-free brokerage. They're super easy to use. You can research stocks right off of their app, and the best part of all is that at the time of me recording this video, Webull is giving you, Minority Mindset fans, 2 free stocks just for investing with them when you use our link in the description below. You get your first free stock just for creating a free account, and you get your second free stock valued at up to $1,400 when you deposit $100 in your account. Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. It's free to open an account, they don't charge you a penny to make a trade, and they're giving you free stocks just for investing with them. So if you want to learn more, get started, and see how you can get your free stocks, I got the links to where you can do that in the description below. Now the market is filled with buyers, which helps push stock prices higher. We have institutional buyers, the wealthy investors, we have the retirement accounts, and now we have the retail or regular stock market traders and investors. At this point, you might be wondering, okay, what's next? Are we saturated with the number of buyers out there? Well, what's next is people will be able to contribute more money through their 401k, and you will see the stock market become even more accessible. We're now beginning to see the growth of micro investing, which allows people to invest a couple dollars or even cents at a time. And there's still a huge untapped market outside of the United States, because it's very hard for somebody outside of the United States to invest in the American stock market. I can't predict the future, but if I had to guess, I would think that at some point in the future, it would be much more accessible for people not living in the United States to be able to invest in the United States stock market. And this leaves me with understanding the strength of your underlying company. At the end of the day, the long-term strength of your stock price is going to be determined by the company's strength. I gave you an example in the beginning of this video of a company who makes $1 billion in a year. If it was a tech company, it'd probably be trading for a lot higher than if it was a restaurant company. The reason that is because people have faith and really believe in the future of technology. These higher valuations for certain industries like the tech industry has kind of been normalized in our stock market. I don't know if that will ever change in the future, but that is what it is right now. But the stock price of a company is going to depend on, over the long term, how good a company is. If a company is on the verge of bankruptcy or it is bankrupt, its stock is going to be worthless. Well, eventually it'll be worthless. Remember, in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. When companies like Hertz and JCPenney went bankrupt in 2020, their stock prices started to soar even though they were bankrupt. It made no sense, but the stock market doesn't have to make sense in the short term. You can study a company's strength by looking at their revenues, their profits, the amount of cash they have in the bank, and their future ideas. All of this is public information if this company is trading on the stock market. But remember, you have to look at everything in context. Sometimes revenues will go up, but profit will be down because the company is investing heavily into their growth. Other times, profit will be up, but they'll have no cash in the bank because they spent all their cash on dividends. And sometimes the stock will rally just because of what they might be coming up with in the future. Like when pharma started announcing that they were working on a vaccine for this pandemic, some of their stocks rallied like crazy even though they didn't have any sort of vaccine yet. These are the things you need to weigh against each other to come up with a good investment decision, and what you need to remember as an investor is one, that you're investing for the long term. You're not a trader, so you're investing for the long term, and second, investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. One thing that can help with your research is staying up to date on what's happening in the finance and business world, and I know that's not always easy to do, especially with the number of news stories being published every single day. Well, that's why we created the free Minority Mindset newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with your money. This newsletter is completely free, and you can subscribe to our free finance and business newsletter by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are separate from our financial education emails. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about why bubbles happen and learn more about the tulip mania bubble that I was talking about, I already made a video on this, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.